All right, so let's begin the show today with NPS. And today in NPS, we are focusing on debt schemes that come under this investment instrument. If you are a conservative investor, how exactly can you look at NPS debt schemes? And are these schemes better than what's already available under investment instruments that we know about? Let's break all of this down. We have Kurian Jose, CEO, Tata Pension Management, plus and Arnav Pandya, founder, Moneyeduschool. Good evening and welcome to the show. All right, so let's get the basics clear over here, Arnav, first, because we are talking about NPS, an investment instrument where we have a different type of schemes depending on the kind of risk profile or the kind of risk appetite an investor might have. But when we talk about specific debt-oriented schemes or fixed income schemes under NPS, could you please highlight those type of schemes?
Good evening. So when you look at NPS, it is a retirement planning instrument which is available for investors across the country. And the key part of NPS is that you as an investor have to make a choice on two main fronts. One is in terms of which is the fund manager that you are choosing to manage your funds. And second and most important is how are you going to allocate the money which you have or the money which you're investing into various asset classes. So NPS gives you a choice in terms of equity. There's an alternate asset class, and there are two debt components to this part. One is corporate bonds and the other is government securities. So when we look at the entire portfolio of the NPS, we have two options within them, which is the corporate bonds and the government securities option, which actually classify as debt for investors, and the debt exposure which the investor decides in terms of their allocation has to be allocated between these two areas. So that is primarily how the investor is going to get a debt exposure in the NPS, and this is what they need to choose from in terms of how much of their investment they are going to allocate to corporate bonds and government securities.
All right. Also, Kurian, if I need to understand the kind of return these debt schemes have given in past few years, how do you think, how do you see them faring as compared to the other fixed income instruments which are available outside NPS?
For having Tata Pension over in your show. To the right question of yours, what kind of returns it has generated? I think the GSEC category has generated about 8.5 to 9.3% in the last 10 years. The corporate bond category has generated anywhere between 7.5 to 8.2% kind of a return. So I think both the GSEC as well as the corporate bond has generated pretty good returns, much better than a lot of other instruments that are available in the fixed income category.
Mm-hmm. All right, but then over here we are talking about NPS, okay, which is actually a retirement investment instrument, Arnav. And when we talk about a retirement goal, if it is timely decided, if it's planned well, it's going to be a very long-term goal, and that's the reason why NPS turns out to be one of the best investment options as far as retirement is concerned, because you've got a longer lock-in till almost 60. So when we have such a long tenure of investment in our hand, Arnav, do you think one should be looking at debt-oriented schemes in NPS, or the better way to utilize this kind of an investment product is to have a certain amount or maybe a higher amount of equity exposure?
So there are two aspects to this. One is the time period when an investor is actually joining or at the stage at which he is currently as compared to the retirement. So for example, if you have still say 20, 25, 30 years to go for your retirement, then having a higher equity exposure is a logical aspect, and which is why also the NPS allows for young investors to have an exposure up to 75% of the portfolio in equities. The second part is that as a retirement planning tool, even though there is a very long period which is available for you till your retirement, it is essential that there is a balance between the risk that you are taking and the goals which are there and the kind of investment that you are making. So typically every retirement portfolio should have a slightly stable element within it, and hence a debt exposure to the retirement portfolio even when you are young, and which can progressively increase as you grow older is a necessity, and it is required, and which is why you will need to have an exposure to both the corporate bonds part as well as the government securities part within your NPS exposure. And for that matter, even when you are looking at your overall retirement planning exercise, it is most likely that the NPS is not likely to be the only option where which you are using for your retirement planning goal. There could be multiple areas that you are investing in, and there also it is necessary that you have exposure to debt, which can increase over a period of time as you inch closer to retirement.
All right, Kurian, I really want to understand now when we talk about debt schemes under NPS, we have two ways of investing in NPS. One is through an auto choice and one is through an active choice. How an investor, as per these respective choices, can opt for debt in their portfolio or NPS investment?
Fair enough. So I think the right question is, I think the first thing that needs to be answered is that why NPS? I think it is a great retirement tool. It has a lot of features which are really useful. And like you rightly said, you have an active choice and an auto choice. Now, I think active choice is meant for the more informed subscriber who knows what his risk-taking ability is and what kind of time frame that he's looking at, and he can allocate between equity and fixed income and alternate assets. If assuming that he's on the conservative side and he wants to allocate between debt only, then he has an option of going 100% into G category or 100% into the corporate bond category and toggle it between either of these two assets. The advantage that he has in the active choice is he can move money between corporate bonds and the GSEC category 4 times a year, and depending upon how rates are moving or how the entire credit scenario is developing up. So, long story short, the active choice allows you to kind of move at an individual level, at subscriber level, between corporate bond and GSEC. But there is a significant segment of our population who may not be fully informed. For them, I think the auto choice makes sense. And the auto choice adjusts between equity and fixed income depending upon your age and how your age progresses. So you have three categories of auto choice, which is the progressive, the moderate, and the conservative, where the equity portion starts from 75%, 50%, and 30% respectively, and it dials down the equity as your age goes up, and it increases the fixed income portion as you go up. So in case you want only fixed income in your portfolio, you need to go the active choice. Whereas if you need a mix of equity and debt, you could look at auto or active choice.
All right, Arnav, if we are talking about debt or fixed income instrument options which comes under NPS, but then it's also very important to give a differentiation or maybe a clarification as to the investment instruments available already, apart from NPS also, which could be a better choice if you want to club this particular investment for your retirement goal. We have the debt schemes available under NPS, but then what about the debt mutual funds and other fixed income instruments which are available?
So obviously for an investor, there are various other options which they can use for the purpose of meeting their retirement goals. So for example, if you are already an employee, you will have the employees provident fund in which there is a contribution going. And this is virtually a debt option in the sense that a very small portion of the corpus goes towards equity, and that to the incremental portion depending on how much is allocated by the EPFO. And the return is virtually announced each year. So in that sense, the return is not floating around too much because it's virtually decided every year, and they try to keep it stable. Similarly, you have debt mutual funds, and within the debt mutual fund categories, you have various options, which includes target maturity funds, which includes various long-term debt funds. So these options are available to you. The question now is that you can use either these debt options, or you can use the debt portion within the NPS for your debt exposure for your retirement portfolio. The question for each individual is this, that how much are they going to invest into areas which give them a sort of a comfort level, because things like EPF, PPF, all these have an element of comfortability for a lot of investors as compared to a debt mutual fund and even the NPS, where the returns are variable. Now you got to look at this in two ways. One is that you might get a better return in these kind of debt mutual funds and all, but you have to have the right inclination and the right mindset for it also, because these are long term products. The rates or the returns will vary. Various debt market factors are at play here, and you need to have patience and understand the entire debt cycle, which goes in terms of a higher interest rate, then it comes down, all those things. So these kind of understanding is also required. And the point is that if you are allocating some money to the NPS, then using the debt option there is not a bad idea at all, because anyways you will have to use some debt within the NPA exposure. But the good part is that if you do not want to lock yourself in the money till you are 60, then you can use the debt mutual funds as an alternative, which you have allocated towards your retirement, but you have a little bit of flexibility in using that money for some other purpose also.
All right. So I also want to understand the tax implication, Kurian, because now since you are investing in debt schemes as per NPS, what could be the tax liability, in what way?
So in NPS, so let me just give you a slight answer to your previous question as well. So like Arnav rightly said, there are mutual funds, there are FDs, there are bonds that are available. You also have the in the NPS you have the tier 2. In the tier 2 also you are allowed to invest 100% into G-Secs and 100% into corporate bonds. And here there is no lock-in at all. So it is equivalent to a mutual fund. It is equivalent to a low-cost mutual fund because the expense ratios here are kept significantly low. So for anybody who does not want to lock in the money for till 60, Tier 2 is an option. Coming back to the current question of taxation, so the NPS is an EEE product. There are very few products that are available as EEE. So at the time of investment, up to 9.5 lakhs can be saved as tax. That is a summation of 1.5 lakhs under ATCCD, 50,000 under ATCCD 1B, and about 10% of your basic, which is capped at about 7.5 lakhs. So total about 9.5 lakhs is what can be saved from a tax, and it is agnostic of whether you are in equity or debt. So that is the first E. The second E is during the time that you spend as an investor, as a subscriber, the entire money is tax exempt. So even if you switch money between asset classes or pension fund managers, the entire journey is tax exempt, which is not the case if you switch money from banks to mutual funds or to other instruments. And the third E, which is at the time of withdrawal. So at when once a subscriber attains the age of 60, you can take 60%, up to 60% of the money can be withdrawn tax free again, and the remaining 40% again is tax free and is invested into to buy an annuity. The proceeds of the annuity, which is the pension income, will be taxed at the marginal tax rate of the investor at that particular age group or at that particular time that he whatever is his like tax bracket at that particular point of time. So this is the only product which gives you an EEE end-to-end EEE product. Only the annuity will be taxed at the marginal tax of the subscriber at that particular age.
All right. Now, let's assume a few scenarios where, Arnav, if someone is invested in NPS via an active choice and has a mix of schemes where they have exposure to equity as well as in debt, what if someone, as per the active choice, starts investing via debt schemes, but then feels that they need exposure of equity also to earn returns and to maybe have the goal accomplished? Can they switch their allocation or their schemes? And if they can, what is the entire process? How many times in a year you can change your schemes and just stay in one pension fund manager?
So obviously, I mean, the answer to this is yes, you can change your allocation if you want to. The other part to this entire issue is this, that see, once you make an allocation towards equity and within various instruments in debt, the logical thing is that you should allow for some time period for this to actually work itself out. Because just because it's an active choice, you have the ability to switch even more than once during the year, doesn't mean that you have to actually switch it. Your switching of exposure from one area to the other should be under two circumstances. One is when either there has been a big change in the weightages due to either say the equity has run up too much or it has fallen a bit too much, or there has been a sudden spike in the debt returns due to say a downward interest rate cycle. If this is the condition, then there is one a reason for you to change the allocation. Two is that if your needs have also changed and your requirements require that going forward you need a different kind of asset allocation, then you can also change. But my suggestion would be that even if you are an active investor, do not quickly or multiple times keep changing just because there is the option which is available to you. Let one asset allocation which you have done work itself out, and if there is a need, you can always change both the fund manager as well as your allocation within the various asset classes.
So, Kurian, ideally, if you could just explain us by example, ideally, how should an NPS portfolio look like? You know, maybe we can just go age-wise. You know, for a 30-year-old, 40-year-old, and a 50-year-old. If someone is invested via active scheme, how can you change your allocation, and what can be the right amount of exposure? Because the goal is just retirement. Okay, and if you're investing at the age of 30, you still have 30 years to go, so on and so forth. So what could be like one model NPS portfolio according to you in terms of exposure?
So, Kavita, I would just like to say you can't have a one size fit all for everybody. Everybody has different risk appetites, and everybody has different goals, and everybody has different asset allocation. I think what is most important is asset allocation as per somebody's risk taking ability. Now, if somebody is 25, I just give you a small question, a small example. Suppose, and that's the question that keeps coming to me is, am I too young to start investing for my retirement? Empirically, what we find is when if somebody invests just a simple small number, about say 5,000 rupees at the age of 25, and his corpus at the age by the time he's 60 is about 4.5 crores. Similarly, when he come instead of starting at 25, the same 5,000, if he starts at the age of 30, the corpus is almost half. So the entire idea of retirement and the entire idea of lock-in is that you get money locked in, and it's like a fill it, shut it, forget it. That you put money, it's for your retirement, and you get it. You take the money out when you require the money. So that is the entire idea of NPS. Having said that, like I said, there is no thumb rule as such. I mean, obviously, one thumb rule is that 100 minus your age is your equity allocation. So suppose you are 30, suppose you are 25, you should have 75% into equity. Similarly, if you are 40, 60% into equity. But again, that's just a thumb rule for a person who may not be fully acquainted with the market. So it finally depends on what is your asset. I mean, what is your risk taking ability? I think time has shown that among all the asset classes, if you have given the asset class enough time in the market, equity capital markets, so equity has given the best returns whether compared to any other asset class, whether it be real estate, debt, bank FDs, or any of them. So personally, we would always advise that investors should be as much, 75% at least in equity, and dial it down as they go up. So since it's a retirement corpus, I think equity is a very important aspect. If equity, and like I said, equity is not for everybody. It comes with associated volatility. So then you could look at dialing down your equity and having more fixed income. So I'm sorry, I will not be able to give you a one size fits all for every age group. It all depends on individual risk taking ability.
Sure. Quickly, Arnav, what would be your answer on this model portfolio?
So model portfolio, I mean, you've got to look at it this way, because you are looking for each individual who's going to decide what is right for themselves. The younger you are, if you are looking at a 30-year-old, the logical thing should be that you should have a higher exposure to equity, and as compared to your debt exposure, maybe you can also have some exposure to the alternate asset class, because that's something different which you are getting within this entire portfolio. How much depends on each individual, how you are going to take, because the idea for a higher equity exposure is that you are making use of the time available to you. Similarly, I mean, when you get to 40, maybe you will be having to dial down that equity exposure slightly, and by the time you get to 50, you should be thinking in terms of ensuring that the risk that you are able to take within the age group of 50 to 60, which could be diminishing, because now as you get closer to retirement, you want surety on the kind of corpus that you have, or which you will accumulate. So keeping these factors in mind, it should be the trend of reducing equity exposure. How much depends on you, and how much you're allocating depends again as for each individual separate.
All right, I think it's time to wrap up the discussion. Thank you so much, both of you, for being on the show and helping our viewers with this aspect of NPS today.
Thank you.
On that note, let's take a quick break, but then post that, let's talk about in new investment trends, from AMC's perspective. What are fund houses doing when it comes to new investing trends? What kind of innovative products are they launching? And what is also grabbing the attention of an investor when it comes to interesting investment themes? All of this and more after this break with Tarun Birani. Welcome back. You're watching the Money Show with me, Kavita Thapliyal. We see a lot of strategies as far as investing trends are concerned, but what trend is exactly being followed by AMCs or investors in terms of investing? What investing trend is not only making money for investors, but also providing innovation and diversification to their portfolio? Let's talk about all this. I have Tarun Birani, founder and CEO, TBNG Capital Advisors, with me. Tarun, good evening and welcome to the show. So I think since pandemic, we've been seeing this new wave of new investing styles and new investing features being launched by AMCs, and because during the pandemic we've seen that even investors have done a lot of research as far as investment options are concerned. They've gotten slightly more aware about financial planning, and personal finance has taken the center stage in their life and in their financial life especially. Since then, we've seen a lot of changes in investment styles, not only because of innovative themes that AMCs are coming up with, but also a change in the thought process, or maybe we can call behavioral finance, which has also changed a lot from an investor's perspective. Currently, right now, what according to you are the other running investment themes adopted or introduced by AMCs?
Good evening, Kavita, and let me start with my understanding and my principle that I feel investing is a very boring thing, and the trends and all these things are something which give me more worry than give me more excitement, because I feel when there are too many things are coming, it is becoming very noisy around, right? So, and you can't create a lot of wealth with noise, right? You need much more clarity, much more simplicity. So I want to start my conversation with that simplicity is the most important part of investing, and investors should remember that. But nevertheless, since you have called me to ask about the trends going on, so based on my understanding, currently we are seeing a lot of flows coming in. At least from last 4 months, I'm observing that mid and small cap funds are getting lot of inflows currently, and rightly so, because last 4 5 months we have seen markets for mid and small caps have been doing particularly very well. And again, if you ask me from a behavioral allocation point of view, if something is going too much up, investors tend to start investing more in that. That's the way how a herd mentality works, right? And that is what I can see currently happening. And there are some valuation red signals which I can clearly see, at least in this category. So one need to be very careful in terms of net fresh inflows into this category. Apart from that, I can see a lot of uh, uh, trend, if I have to say, from an asset allocation category, is finding a lot of inflows in terms of dynamic asset allocation or multi-asset funds, because after this March ending, the new debt fund taxation rule which has come in, the debt funds have become unattractive immediately after that. And due to that, investors are looking at some bit of more conservative strategies. So we have equity savings category, we have multi-asset categories, we have a balance advantage category. So we are seeing a lot of repositioning happening in those categories. So there also you could see a lot of inflows or the new money which is coming in. Apart from that, we could see some smart beta strategies are also finding a lot of favor in terms of passives. So passive is, and I'm very happy to see that there is a lot of inflows in the passive side. And in passives also, we could see a lot of smart beta strategies with single factor and multi-factor models such as quality, momentum, low volatility, and all these also getting some new inflows coming in. Apart from that, you could see, since India is getting in center stage and you are getting a lot of positive media attention across the globe, right, on India due to the GDP growth and all those positive things coming in for India. So you could see a lot of thematic and sectoral funds are also finding a lot of attention from investors. And there is actually a lot of fascination from retail investors. Maybe there is some bit of FOMO also, fear of missing out, and investors tend to find such themes to make up
Are
for the
these
lost time.
okay?
So you could
So
see.
Tarun, are you also trying to say? Are you also trying to say that it is not just the momentum that AMCs are trying to catch by introducing these kind of new investment trends, or even the kind of themes that you just mentioned? Are we also trying to say that this is a momentum play through AMCs, these new investing trends, and because an investor is now getting aware about their finances and maybe getting introduced to all these investment instruments and investment trends, they just latch on to it because they see something very new and very exciting. Is that the case over here, and which is why we are calling it an investment trend?
So, yeah, at some point, yes, but I think everybody has a way to look at investing, right? Somebody who is very seasoned, experienced investor. So, let's say you have themes like new manufacturing funds coming in, new business cycle funds coming in. You could see some quant funds coming in. So, investors who have understanding, serious understanding of these funds, or who have seen, let's say, a global trend in such categories may want to invest in that, but that requires a much long-term outlook. What I feel missing is investors are sometimes jumping into it without understanding these themes may take a little more longer. Let's say a manufacturing theme, if I have to look at, may take a little more longer than any other category, because this cycle has to, the capex cycle has to really play out for a long period of time. So investors need to have a much more longer outlook. So the money which is available for 5 years, 7 years need to be invested in categories like that. But let's say just because there is a new fund coming in or there is a lot of FOMO in the market, people tend to invest into these categories intuitively. So that is little issue which I feel investor in the investing style right now. But nevertheless, there are some interesting categories like passives, and that is very heartening to see. There is a lot of positive flow happening there. So, and all these smart beta strategies and all that also are very attractive for investors from a long-term point of view.
So one thing is very clear, that you should know the kind of diversification you want to follow, and also do not fall into the category of herd mentality. You should know what suits you, even if the investment trend or the theme looks very exciting and maybe has really worked out for someone else, doesn't mean it will work out for you also. But apart from that, the kind of trends you've mentioned, let's assume an investor has the co-portfolio already in place. Do you think these kind of innovative themes can then be introduced in their portfolio, even if someone has to go for it?
So if you ask me, as I started my conversation, that I am from a school that investing is a very boring thing and simplicity is something what I like. 4-5 core strategies can really take care of your long-term financial goals. A good large cap fund, or a good mid cap fund, or a good small cap fund, or a good multi cap fund are only one which you require. You don't need too many fancy categories or funds to achieve your wealth creation goal, right? Nevertheless, but people who have, let's say, understanding, and who can take a little more longer term outlook, or who are more, I would say, more sophisticated investor, they can definitely look at all these trends and categories with reasonable understanding. Yeah.
Exactly. That is what I want to I want you to elaborate on the reasonable understanding, because the kind of themes you're talking about and the ones that been highlighted by you also, we're talking about thematic sectoral funds, ESG, smart beta strategies, mid cap and small cap, overweight, which as per the trend people are really opting for. What would be the pros and cons of following these kind of themes, if even if one has to, how to make sure that you've got enough understanding what could be a side effect of just investing in these kind of trends blindly?
Yeah, so let me give you an example. In
Sure.
2000, technology theme was one of the favorites at that point of time, right? And after that, we have seen NAVs of technology funds or the IT funds have really crashed after that, right? So, perils of investing into a sector or a thematic oriented strategy is when, let's say, there is any risk which comes in that category. You will see a very large part of money we can be lost because of that, right? So, which I think most of the investors are not aware that sectoral or the thematic funds run that kind of risk, right? That is one problem. Mid and small cap, according to me, is again a play wherein people end up going based on past returns, and you will always see mid and small cap will always deliver, let's say, in a momentum market, better returns than let's say a normal large cap fund or index fund. But what happens in these funds, whenever, let's say, there is a correction happens, you would see a very large correction happening in these kind of category. So I don't know how many investors are aware that the correction also will be that large, and due to that they are caught off guard. And so let's say if you invested at 10 lakh rupees and you made 20-25% return in a small cap fund, and let's say if a correction happens, a large cap will fall by 10%, and let's say small cap falls by 20%, 30%, you will see your capital wiping out very quickly in that category. So I think from a durability and long-term return point of view, how many investors are making allocation based on, let's say, I will not increase the small cap by more than 15%. I will not go more than mid cap into more than 10%. Because there is so much noise around it, investors tend to get caught in that noise, and maybe they may take 40% into a small cap category or a 50% into small and mid cap category, which end up resulting into a large erosion of wealth, right, at that point of time, or a thematic or a sectoral fund at that point of time. So according to me, investors need to be very careful, and they need to follow suitability and asset allocation at all point of time. Asset allocation is the dharma, which they should not let go off guard even if the markets are going crazy or going up. That is what my advice would be.
All right, Tarun, I think beautifully explained. Thank you so much for being on the show and helping our investors as to how can they diversify their portfolio, focusing on these new investment themes. Thank you. All right, so let's slip into a short break, and post that, let's get your financial portfolio answered by our expert Pankaj Matpal today. Watching the Money Show with me, Kavita Thaplial, and that's the last part of the show where we take viewer queries, because the plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Pankaj Matpal, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us on themoneyshow@etnow.tv. All right, good evening and welcome, Pankaj, to the show today. And let's get our first viewer online, Mr. Janardhan HL. Good evening, sir. How are you doing?
Fine, ma'am.
Mr.
I'm
Janardhan?
Janardhan from Bangalore.
Hi. Okay, hi. All right, thank you so much for sending us your question. You want to understand the tax treatment? Yeah, sure.
Yes, ma'am. Yes, ma'am.
All right. Are you already invested in mutual
Yes, ma'am.
funds?
From last 1 year,
Okay.
I have started investing in SIP.
Mm-hmm.
So I'm a long-term investor planning to invest for next 15 years. Just I wanted to
Sure.
know the tax implication on the mutual fund redemption.
Sure. Sure. Are your funds equity-oriented funds?
80% equity and 20% debt, ma'am.
All right, so let's explain you and in fact the rest of the viewers also the tax implication that's involved in equity mutual funds and debt mutual funds where there has been a major change also. Pankaj.
Yeah. See, till 31st March 2023, there were two categories for taxation purpose, one equity and non-equity. So any mutual fund which has equity allocation, minimum 65% in that was equity, and now also that is called equity. Another category was non-equity where the equity allocation was less than 65%. But now from 1st April 2023, there are three categories. So one, as I mentioned earlier, equity category, it may be equity or hybrid, but equity allocation in that scheme of the total asset of that scheme should be minimum 65% to qualify for equity. Another category is, we'll say debt, where the equity allocation is less than 35%. So it may be equity, it may be, conservative hybrid, it may be debt, it may be gold or silver fund. So these are debt funds now for taxation purpose. Third category is again hybrid, where equity allocation is above 35% of the total asset of that scheme, but below 65%. So that is another category. So equity category, when we calculate tax, holding period up to 1 year, or you say 12 months is short term, about 12 months is long term. In short term, whatever the total gain, that will be taxed at 15%, and the capital gain, which is long term in nature, is taxable at 10%. And there, one important point, that up to 1 lakh long term capital gains from equity in one financial year are exempted, and only amount exceeding rupees 1 lakh will be taxable. So this is about equity. And as I said, one category, debt, where the equity allocation is less than 35%. There is not short term or long term. Whatever total gains will be taxable at your slab rate. Means you are in 5%, 20%, 30%. Whatever the income tax rates are applicable to you, the capital gain will be taxed accordingly. But this is applicable only for the units which have been purchased on or after 1st April 2023. If you invested earlier than that, then old rates will be applicable. And another category, as I said, where the equity allocation is above 35%, but less than 65%, there a period up to 3 years is short term, above 3 years long term. In short term, the total gains are taxable at slab rate of the investors, and long-term capital gains are taxed at 20% with the benefit of indexation. But in this category, not many choices are available. So right now, either the funds qualify for equity taxation or they qualify for debt where there is no indexation benefit. But for the understanding, there are these three categories for the calculation of tax.
All right, so very well explained. All the best, Mr. Janardhan, with your investment portfolio, and I hope that you've got the tax implications answered. We move on. I have Thomas' question, and he has invested. He's invested in HDFC Nifty 50 Index Fund, Parag Parikh Flexi Cap, PGI Mid Cap Opportunity, Axis Growth Opportunity, and he wants to understand if he can move to a Nifty, passive Nifty 150 Mid Cap Index Fund for better returns. And he also has to say that the goal that for which he's investing is for his kids' education and a house. All right, Pankaj.
Kavita, see, if you talk about large cap index, Nifty 50 or Nifty 100, so I have seen that most of actively managed funds have failed to outperform these indices. But when we talk about mid cap or small cap, most of actively managed funds have outperformed these respective benchmarks, indices. So considering that fact, when Thomas wants to know about the mid-cap index fund or actively managed, my suggestion would be that he should stay invested or he should invest in actively managed fund. Or if you want to invest in two funds, then it can be a choice that one mid-cap index and one mid-cap actively managed fund. And what I understand here, because Thomas has PGIM India Mid-Cap Opportunities Fund in his portfolio, and he may not be happy with the performance of the last 1 year of that scheme. But if you see the portfolio of that scheme, I expect that scheme will perform better. Last 1 year has not been very good for the scheme, but Thomas should stay invested in that scheme. And in general, also, I'll say for mid-cap and small cap that you should have actively managed funds in your portfolio.
All right, so that's a solution. We move on and we take Abhishek Basu's question. And he wants to do an investment for a long term, almost 20 years. And he also wants you to explain him whether he should be in an index-oriented fund for 5 years, or he can switch on to some other strategy. Okay, so the question over here, sorry, I think I read it wrong. He wants to understand that if the fund is not able to beat the index in the first 5 years, should he be continuing in that particular fund, or he should switch to another fund just because there are no benchmark or index beating returns?
Definitely, Kavita. See, though I'm against switching from one scheme to another scheme very frequently, but as it is mentioned very specifically, 5 years. So if a scheme is unable to beat its benchmark for 5 years, then definitely you should think about switching from that scheme. Even for 2-3 years also. See, it may be a short period of 6 months, 1 year.
So over here,
Pankaj,
like for example, for example, we've seen the large cap category not performing really well since a couple of years. So even then, when not only your fund, but the entire group of that particular category is not performing, even then you think that one should be ready to switch if the category itself is not performing?
Definitely, Kavita, if any category, what is the objective of actively managed fund? To beat the benchmark. If an actively managed fund is unable to beat its benchmark for long term, or you are saying that we are seeing consistently, means returns are lesser than the benchmark, then there is no reason to stay in those funds. But yes, if you see that there is some period where the schemes are not performing, but in long term, there are schemes which have been able to beat their benchmark, then only you should think about. But in large cap, I agree, most of large caps have failed. Actively managed funds have failed to beat their benchmark. So that is why means now you go for large and mid cap fund, or you go for mid cap funds. That should be the strategy. But purely large cap these days, even my observation is this, that most of schemes have failed to beat their benchmark. In that case, it is better to invest in Nifty 50, Nifty 100, or we have other large cap like equal weight index funds or something like this. So investors should go for that.
All right, I think with that, it's a wrap. Thank you so much, Pankaj, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your financial portfolio queries. Thank you so much for watching. Goodbye.